So, turn on my mic. We'll call the February 14th meeting to order. Item number 2 on our agenda is the swearing-in ceremony for Kenton Sudell.
Good morning. I'm Frances Kersey, and I have the honor of swearing in Kenton. He has this down pat now. I state your name.
I, Kenton Sudell,
Do solemnly swear
do solemnly swear
that I will support, obey, and defend
I will support, obey, and defend
the Constitution of the United States
the Constitution of the United States
and the Constitution of the State of Oklahoma,
and the Constitution of the State of Oklahoma,
and that I will not knowingly receive,
that I will not knowingly receive,
directly or indirectly,
directly or indirectly,
any valuable thing
any valuable thing
for the performance or non-performance
for the performance or non-performance
of any act or duty
of any act or duty
pertaining to my office
pertaining to my office
other than the compensation allowed by law.
other than the compensation allowed by law.
I further swear
I further swear
that I will faithfully discharge my duties
that I will faithfully discharge my duties
as a member of the Oklahoma City Employee Retirement System Board
as a member of the Oklahoma City Employee Retirement System Board
to the best of my ability.
to the best of my ability.
Congratulations.
Thank you.
I'll bring them up to you.
Come on up, Kenny. Congratulations. Item number 3, we have some presentations this morning. Jason, you want to give us a little prelude, please?
Just a regular update from your 2 small cap managers. As you all know, you have an allocation to 10% of the portfolio to small cap U.S. managers. It's divided between a growth and a value manager that complement one another. So I think first up this morning is Ernest Partners, who is your small to mid cap value manager. I'll turn it over to them.
Okay. Good morning.
Good morning. Thanks for having us in.
We usually, if we follow a standard format, we figure about 15 minutes for the presentation and about 5 minutes for Q&A. So.
Okay, that sounds good. Make sure you get that out there early before someone starts running long. Well, good. Well, first of all, thanks for having us in. This is not our first time out here. You have been one of our partners for a long time, since 2003, and it's been a good partnership. So it's good to see everyone again, and we always look forward to giving you an update on the portfolio. We spend kind of every day thinking about the portfolio, trying to find the best securities that we can find so that over the course of time you look back on that and say, hey, we're glad you hired Ernest Partners. And then, of course, to be able to come out here and share with you kind of our thoughts is always a fun and interesting thing. So just as a quick reminder, there's a short bio on myself and Richard at the front of the book, but really what I want to get into is kind of Ernest Partners and how we shepherd your account. As a quick reminder, we are a fundamental bottom-up manager. So when we pick securities, it's not based on a forecast on an interest rate or maybe the pace of growth of an economy and then try to find companies that fit that forecast. But instead, we're going out and looking at individual companies and trying to identify where are there good companies, good businesses where for one reason or another the market has mispriced that asset. And when that occurs, then that's the opportunity for us to go in and buy the name. In our approaches, we think that when you look at a company from an investment standpoint, you want to be able to look at it from 2 lenses, dual lens. And those lenses are first that of an analyst, but then also that of a practitioner. So what we've done over the last 20 years is we've pulled together a team of people where everyone on the team has some type of industry experience, where someone worked in a technology company or an industrial company or a transportation company. so on and so forth, with the idea being that we can look at that company from the perspective of having been in their shoes before. And then we look at the company from that of an analyst as well. We kind of combine that approach with the idea of putting together a 60-stock portfolio that over time manages risk and then outperforms the benchmark that you've given us. So that's our approach and that's our history. So with that, why don't we get started in the book? And if you flip past the bios, obviously you've given us some guidelines, and we work in conjunction with ACG to make sure that those are adhered to. We are adhering to those. We have exceeded the benchmark over a full market cycle. Obviously, if there's any changes there, let us know, or ACG, and we'll incorporate that. But we have a system in place by which we don't broach those guidelines. There's an equity market overview, and I won't read through the equity market overview. I'll leave that for some of your exciting reading on the weekends. But if you think about since the last time we've seen you, it's been an interesting market, right? You've seen a lot of volatility, especially here in the fourth quarter. And in reality, volatility is actually, in a way, a good thing for us, because when you have volatility in the markets, a lot of times assets can get mispriced, and it gives us the opportunity to go on your behalf and buy names that are mispriced. But several different themes have kind of dominated the markets over the last year plus. The first has been interest rates. If you think about this portfolio, we're buying small and mid-cap companies. So we're buying companies that have a capitalization of somewhere between $300 million and kind of up to that mid-cap range, which can get you up around $15 billion, maybe a little over $15 billion from an initial purchase standpoint. And most of them are the revenue is primarily here in the U.S., but given how international business has occurred and the revenue stream of these companies, you do have revenues that are outside the U.S. So when you think about rates and interest rates, the U.S. has been in a much different dynamic as it relates to rates as the rest of the world, but interest rates have had an impact on how we've invested and how companies have been affected. So here in the U.S., clearly we've been in a very, very low interest rate environment, and we're starting to see that come up, whereas if you look at different parts of the world, they're not in the same situation. You have a lot of parts of the world that are actually in a negative interest rate environment, which is kind of unusual. You've got to pay someone to give you your money back after a certain period of time. But nonetheless, that has had an impact on how we've managed the portfolio, paying attention to what the Federal Reserve has done. Also, if you think about trade around the globe, that is changing every day. And then clearly from a policy standpoint, there's been a lot of attention there. And so we have to look at how does that affect the companies that we own. We're not trying to make a trade, or we're not trying to buy a company based on the direction we think that is going to occur, but we're basically looking at companies and saying, hey, given the current environment, which companies are going to benefit and which companies are not going to benefit. And anytime there is change, there's going to be companies that do well and there's going to be companies that don't do as well. And so what we're doing is trying to take advantage of that change for the companies that are actually going to be advantaged from the change. So those have been some of the highlights that have kind of moved the markets around. You can look through here to get a little more detail in terms of what's occurring on that front. If you take a quick snapshot at page 4, you probably see this because you get this on a regular basis. What this shows you is the different economic sectors on the left. Since the last time we met with you, you'll notice that there's a new economic sector. It's called communication services, so it's the fourth one down. It used to be called telecom, and they've rearranged some of the names that are in that sector, but this will be the first time you've seen that. This page right here is a little unusual because it really highlights the last quarter, fourth quarter of 18, and then the last 12 months as of December 31st, so the calendar year of 2018. And there's a lot of red on this page. Now, if we were to update this page as of January 31st, you would notice that everything kind of flips the other way, and there's a lot of blue, another indicating positive returns. And that just highlights the volatility that you've seen here recently. This is the benchmark. This is not your portfolio, but it gives you a sense for kind of the environment that we've come out of. And the one thing you'll note here is that for the full year, the one sector that actually had positive returns was utilities, which kind of makes sense. When you get in an environment like we had in the fourth quarter of 18, where there's a lot of uncertainty, what typically happens is people will kind of migrate towards assets that are seen as a little bit more defensive, that might have a little better yield associated with them. And so it makes sense that utilities go up. We don't manage the portfolio like that because we don't want to be chasing kind of in the short run what's happening. But nonetheless, if you'd been in utilities going into January of 19, you would have left a lot on the table. But that just gives you a snapshot of what the market has done. Okay, now let's get to what's important, and that's your portfolio. If you turn to page 5, you'll see just the ending value as of December 31st. You can see that the yield on the portfolio is about 1.3%. We're not buying companies for yield. We're buying companies for total return. And then you can see that it's fully invested in the bottom right-hand portion of the page. If you go to the next page, you'll see performance. We did update performance through January 31st, just given the swing that you've seen in December and January. And you can see that on a one-year basis, the portfolio is down about 5.5%, and the benchmark's down about 3.8%. So the portfolio trailed by about 176 basis points. Now, the reason for that is that we were underweight utilities. And as I mentioned earlier, being underweight utilities, which did really well last year, was a headwind to the portfolio. But we think that's the right thing to do on your behalf, because when we look at how much we have to pay to buy a dollar of earnings in utility companies compared to how much we have to pay to buy a dollar of earnings in other places in the market, and we look at it over a full cycle over the next kind of 3, 4, 5 years, we think there's a lot more value elsewhere in the portfolio. Now, if you look at it longer term, if you look at the last 2 years, you can see that the benchmark is up 3.4%, but your portfolio is up 8.1%. So about 470 basis points of outperformance. And then on a 3-year basis, the portfolio, the annualized return is 16.4%. The benchmark's about 12.6%, so again, about 360 basis points. And then just from a 10-year standpoint, we didn't put the 10-year in here, but just to give you that number, the portfolio is up 15.3%, and the portfolio is up 15.3%, and the benchmark's up about 13.9%. So continue to outperform the benchmark on a relative basis, and then from an absolute standpoint, obviously SMID cap has been a good place to be. Now, at the end of the day, we know that you can't spend percentage returns, and that's what our industry always likes to talk about. You spend real dollars. So if you go to the next page, this gives you just a snapshot of your growth with us since 2003. You funded the account with about $17.2 million. Since 2003, you've actually withdrawn about $27.5 million to pay benefits. And then through investment performance, the portfolio has generated about $50.5 million in returns, which gets you to the ending balance of $40.2. And then for the month of February, the portfolio is up another 2.9%, and the benchmark's up about 1.3%. So February continues to kind of reflect what you saw in January. Now, at the end of the day, our returns come from picking securities. So we wanted to give you a little bit of flavor and stay within the timeline. So we've got about 6 minutes left. We'll talk about a couple names in the portfolio, and then we'll open it up for questions.
So I'll turn the page, ask you to turn the page to page 8. We'd like to give a couple of examples of companies across the portfolio that have contributed to that strong performance that Patman referred to. One of the companies I'll direct your attention to on this page is Sunoco Products. So Sunoco Products is a global packaging company, both paper and plastic packaging. And their focus really has been on both growing the business here in the U.S. as well as outside the U.S. And one of the things that caught investors off guard and benefited you as holders of this security over the course of the past year has been really around input pricing. So the company has an integrated set of operations where they're going out and they are sourcing raw material on the paper side. And the cost of that has actually gone up. But because they have these operations that are internal to their business, they're able to go out and source that paper packaging raw material at lower cost. And so what has happened is, in the context of strong demand for the finished product, they're seeing nice growth in earnings because their costs have gone down, and they've been able to keep the benefit because of the strong demand has kept prices strong on a national basis here in the U.S., which is where roughly 70% of their business is on a go-forward basis. So as Patman mentioned, we're looking for securities that have stronger prospects than are expected by other investors. And in a year where overall performance for the benchmark was actually a bit weak, Sunoco actually generated a positive return last year, and with a dividend yield of about 3%, the return was even greater than that. So just an example of a company in the portfolio that's been a strong performer over time, and last year in a down market, actually the security returned a positive performance. So if I turn your attention to the next page, page 9, what you see there shows a breakdown of the portfolio. And what it does is it breaks the portfolio down by the 11 different economic sectors. And so you see 2 bars on the page for each of those different sectors. The blue bar is the weighting of your portfolio to that particular economic sector, and the red bar is the weighting of that to that sector of the benchmark, which is the Russell 2500 Value Index. And so that's the bar in red. And so as you can see, Patman mentioned that we were underweight last year to utilities, and we also have an underweight to some of the consumer sectors, both consumer staples and consumer discretionary. And where we have overweights are in sectors like industrials and information technology. Patman mentioned some of the volatility in the fourth quarter. We did take the opportunity to enter a position in a new name in the industrial space. Just take a minute to tell you a little bit about that purchase. So the company is Triumph Group. Triumph is an aerospace and defense supplier. So they provide a range of different systems and components that are used both in commercial and defense aircraft. And what was really, I think, in the moment misunderstood by other investors was that the company was coming through a period of time where the business had been very challenged. For about 5 years, they had seen their revenues related to defense airplanes actually come down. And that was because they were tied to some of the bigger aircraft that the U.S. government was not purchasing anymore. But what people didn't understand was there was about to be an opportunity that had been in the works for many, many years on the Air Force tanker, which really the process of acquiring this aircraft goes back all the way to the beginning of this century, so the beginning of kind of the 2000s. And there was a lot of consternation in Congress in terms of actually approving the funds and deciding which aircraft to buy. And as a supplier to that aircraft, Triumph wasn't benefiting. They were spending money to develop all the things that they would need to do to make sure that when the money came, that they were ready. But ultimately what has happened finally, and Oklahoma actually saw the delivery of the first KC-46 over to Altus Air Force Base earlier this week, you're starting now finally to see revenues start to flow. And Triumph should benefit on the defense side of their business, which again had been challenged for a number of years. And I think as investors start to see that the defense business is not systemically challenged, but rather cyclically challenged, and about to move into a period of cyclical growth, that will ultimately drive the shares from a depressed valuation. We made the investment earlier, as I mentioned, in the fourth quarter, and the shares are up about 20% since the time we purchased the name. So it just gives you an idea of the type of things that we're looking at when we make an investment on behalf of our clients.
And then the last thing I'll kind of share with you is being a small to mid-cap company, a lot of times we do have companies that are bought out by other, whether it be a financial sponsor or another strategic players. You did have 2 names within the last 12 months that were bought out at a pretty healthy premium, anywhere from kind of 40 to 50%, one within energy and one within your communications. But those are some examples of some recent sales. But for us, we're fairly agnostic. If the market recognizes the value over time, we come up with an investment thesis. If that thesis gets recognized by the market over a full cycle, that's great. If someone comes in and says, hey, we see the value that the market's not seeing and is willing to pay a premium, then that works as well. So you get both of those instances in a small to mid-cap portfolio. So with that, we'd be happy to open it up to any questions.
Yeah. But when we look at traditional value
talk about that?
Talk about that. I mean, certainly benefited in this period where more growth-oriented sectors have outperformed value substantially, and you've outperformed peers.
Yeah.
Just talk about
How that works.
incorporate value.
Yeah, so what he's referring to is on page 9, if you'll see, we have an overweight to certain sectors that would be kind of deemed more growthy, whereas you think of value sectors being more kind of utilities, telecom, you think of growth sectors being more kind of healthcare, industrials, information technology. And when we look at, and that's kind of risk. Anytime you're different than what would be kind of the benchmark in those areas, that would be considered risk. And sometimes people will look at a portfolio from a silo and just say, hey, based on your sector weightings, you look a little growthy. And we do look a little growthy because we have overweights in those sectors. But what's interesting, if you were to look at our technology names compared to the benchmark technology names, from the standpoint of price to book or even price to earnings, our names trade at a discount even to kind of the value benchmark. So when we're buying names within that space, it has kind of that value bias to it. But when you kind of step back and look at it holistically, and so what we do is we look at our sector weightings as well as about 17 or 18 other risk factors in terms of what's our earnings volatility relative to the benchmark, what's our beta relative to the benchmark, et cetera, et cetera. And we say, how do those risk factors blend together so that when you blend those together, you're getting a portfolio that kind of represents the Russell 2500. So that's what we've tried to do over time. It's just that this is kind of the result of where are we finding the best opportunity from a bottom-up perspective. Now, our beginning universe is the Russell 2500, so we're not buying any names that aren't, starting in that Russell 2500 benchmark. But the way they're skewed right now, it looks a little growthy just because of the sector weighting. Once you would break it down to kind of more fundamentals and just compare tech companies against other tech companies or healthcare companies against other healthcare companies, it still kind of has that value bias.
I had a question, excuse my ignorance, on page 11, you've got benchmark risk, and you've got a little chart there, and it says probability of exceeding risk target 86%. What is that telling me?
Yeah, okay. So we've developed our own risk model internally, and we call that model downside deviation. And what we've done is we've essentially, with downside deviation, the focus of the risk model is to focus on how do we protect the portfolio on the downside, okay? What's that? That's right. Now, it's not so much, sometimes people look at downside capture as, hey, when the market is down, how well do you protect? And upside capture is when the market is up. We're looking at it just relative to the benchmark. So if the benchmark, is up whatever, what we want to do is establish a minimal acceptable return in the portfolio. So in your portfolio, the minimal acceptable return is 4% below the benchmark. And then what we want to represent to you is that 80% of the time that we're going to meet or exceed that minimal acceptable return. And what this is telling you is that when we ran the risk model as of December 31, based on the names that we have and the risk associated with those names, it's actually closer to 86. So there's some margin there. Now, it's not an optimization, so we're not going to take that 86 and bring it back down to 80. But if it were to go to 79 or 78, that's where we would make the adjustment and bring it back up to 80, because we can see the marginal contribution to risk of each name.
So did I understand that it's an 86% chance that you're going to beat the minimum acceptable risk?
Correct.
Return?
That's right.
Okay.
Yep. Yeah, it's just saying that the probability of exceeding the MAR, the minimal acceptable risk, or minimal acceptable return, is 86%. So it's actually less risky in a way because you're at 86, whereas it could go all the way down to 80, because what we want to do is we really want to go out and find names where we have a real high certitude alpha and own as much of those names as possible, subject to managing the risk. But right now, that result has been a portfolio that's kind of at 86. There have been times where we've been in here where it's been at 81, 82. It changes as we buy and sell names. But there is a focus on making sure that, if you look at a lot of traditional risk models in the marketplace, they'll focus on kind of just tracking error or standard deviation. And what that means is if you have a portfolio, let's say, that does a benchmark that does 10%, If you have a portfolio that returns 6% and another portfolio that returns 14%, those two portfolios are equally risky because they're kind of equidistant from that 10%. And so what we've said is, hey, the 14, that shouldn't be considered risk. Let's just focus on the risk of being to the left side of the benchmark. And so when we construct the portfolio, we want to take that into account as we weight different positions and which names we own. Yep.
Anyone else have any other questions? Gentlemen, I don't have any questions, but I want to thank you both sincerely for your military service.
Oh, thank you. Yeah, appreciate that. Not everyone at Ernest Partners is from West Point. We just happen to be the two that got put on this trip. But thank you very much. Appreciate it.
Okay, thank you.
All right, thank you.
Okay, next up, we have Times Square. Good morning.
Good morning. Well, thank you very much for having me. I'm Jeff Bramer from Times Square Capital Management. My pleasure to be here. It's been about 2 years, I think, since you last had me in. And unlike some of the last times I've come here and over the years since you hired us, I want to do a little bit differently and not talk too much of the book, because I'm coming in with a performance that's quite below our expectations and certainly below yours relative to benchmark. And I'd like to talk a little bit about that looking back, particularly the last 5 years, where we've lagged your benchmark by 3% over that period of time. And there are a couple of things going on, both in the market related to our process, that I want to address and talk about why that's happened, and more importantly, why I think that is no longer going to happen, why I think our outlook is more positive than it's been over the past time. So if you indulge me for a moment, our approach is very much, bottom-up stock selection process. I hear a lot of echoes in our approach from Ernest, so you all have a type, apparently. We look at individual names. We care very much about the growth these stocks will have, but we also care about the valuation. We care about how much we pay for that growth. And one way of looking at that is how much earnings translates to the price that you currently have to pay for that stock, or the PE ratio. And what's interesting over the last couple of years is that within the growth index, and now I'm thinking just within the Russell 2500 growth index, which is our mid-cap growth universe, stocks that have high valuations or very expensive on that measure compared to those that are more attractive and the ones that we generally prefer have underperformed. And just to give you some numbers for that, if I look at 2017, if I liked lower valuation, more attractive names versus those high ones, I would have underperformed by about 1,200 basis points, just going one versus the other, in terms of how much high valuation or overpriced, in our definition, outperformed attractive valuations. And that's something we haven't really seen since the late 90s, where you just bought whatever you thought was going up, and that momentum kind of kept carrying it. And we thought, okay, this is probably kind of an extreme. It will pull back somewhat. And then 2018, particularly in the last part of the year, it got even further. And that spread was closer to 3,000 basis points. And I think what was happening is within the growth space, there was a disregard for any sort of bottom-up valuation approach. And whatever worked, whatever was perceived as being safe, kept going. Software companies, consumer staple companies, were the strongest performers within our universe. And that's kind of an odd thing to say in the same sentence, because you think about software, tech, IT, these high-growth names and these sort of safe, staple names not doing very well. For us particularly, we've had a lot of weakness in our healthcare services area. Now, healthcare is an area that we tend to have a lower exposure to the benchmark because there often are high valuation or lack of earnings with a lot of the biotech names. But that's actually accounted for about half of our underperformance over the last 5 years within this small but yet significant area of the benchmark. Now that causes us to look internally and think, okay, are we doing something wrong? What's going on in our process or approach? Now it's the same portfolio management team that's been running your portfolio really since the inception of the strategy, but we have made changes among our research analysts. And over the last 2 years, we have made a couple of changes that we believe are for the better of our process, and one of them actually related to the healthcare services area, where we had a gentleman join us back in 2015, so a little bit before my last visit to here, and we found that he just didn't work out for us, and his ability to pick stocks in healthcare services detracted from portfolio performance. And I'm thinking across the board for our small cap, our SMID, which we managed for you, as well as our mid cap. We parted ways with him at the start of last year and brought in a new person who we think has a much better ability to do that. And we think about what did we learn from that experience with having Samir here and not doing a good job and trying to find more non-consensus views. That said, we've also made mistakes, and I think we can learn from them. Last year, we thought Delphi was a wonderful name to have. This is an auto parts company. It had sold off somewhat from the 50s down to the 40s. There was a lot of negative sentiment around auto parts and whether we hit peak auto sales. And we thought, well, they've got great components, great power transmission that are used for EVs, hybrids, as well as traditional internal combustion. And we thought, okay, it came down about $10. Perfect. Great valuation now, it's appropriate. What we didn't realize was that the sentiment was still, another shoe was to drop, and possibly another 2 or 3 came on that stock. And after having bought it in July, it continued to go down, and we realized, all right, this is a mistake, and we sold it in October. And it's unusual that we sort of have a point in time where we've bought a stock and sold it so quickly, but I think we've also realized that we can't hang on to names as long as we might have done in the past, because that's detracted from our performance as well. Sometimes it's a matter of timing. Last year, which was a particularly tough performance period for us, we started a new position in a company called 2U. It's a software company. It probably falls more in the consumer space. They do a lot of services for universities for the degree programs, often provided online. But they work for people like Pepperdine, Vanderbilt, Rice University, UNC, USC. We'd owned it for a number of years in our small cap portfolio, which often becomes a good source of ideas for your portfolio. It had grown. It had done very nicely. We bought it in May, and timing-wise, in July, there was a short seller report on the stock that raised questions about their potential growth trajectory. We did not believe. We reviewed the information. We thought a lot of that was faulty reasoning, but still, in a small cap space, that took a hit on the stock, and it pulled back significantly, of course, 2 months after we added it to your portfolio. Now, here's a consideration where we thought we actually have a lot of conviction in this name. We think very highly of it. We continue to build that position. It's actually been quite a strong performer year to date since the year turned over. Speaking of that, we've seen a little bit of a reversal and a return to fundamentals thus far in 2019. And looking at your portfolio's return thus far this year, the overall markets come back up strongly, and that's great from an absolute return perspective. It's about 16%. The index itself, your portfolio is of about 18% relative to that. And a name like 2U that I mentioned before, which is down about 30% last year, is up about a little over 30% year to date as some of that reversals come in. So I think the position of the portfolio works well for us. When I look at the top names in the portfolio, and here I will go back to the book. If you go to page 19, you'll see a list of the top 10 positions in the portfolio. And looking back over these names for the past year, what I'm pleased is that all of them outperformed the 7% drop that the index had last year. In fact, only one of them was negative. So this tells me when and I think you all will be far too polite to actually ask me this question, but internally we sort of wonder, gee, what's happened? Are we just gotten stupid at Times Square and not able to figure out what's going on? The names that we have the highest conviction in are doing well. The names that we think most highly of are doing well. And yes, there have been some environmental problems in the market as a whole that have been for us, and we've had some of our own selection problems, and I think we've changed, of course, with some analyst changes as well. And I think that's positioned the portfolio well going forward. And on the conviction idea, and there have been clients who have asked us about this. We had one client last year convert their portfolio in this strategy to a more concentrated version. Your portfolio typically has about 100 names, it's a broad-based portfolio. But one of our public clients in this strategy moved it to a concentrated version last year. And while that also underperformed the benchmark last year, the margin of underperformance was less. It was closer, doing better than the broader one. Now, over time, that may not always be the case, but again, that points to the names where we have conviction, where we're putting most of their capital of your portfolio, are doing better than the rest. And that leads us to think that we can adjust and continue to move the portfolio in ways that will add value to your assets going forward.
So you recently announced that you're reopening small cap. It's been closed for a number of years. Certainly questions could be asked if performance has been poor. Is that a result of asset flows or liquidity in the market?
Sure. So Jason's referring to our broader strategies. If you maybe just if you turn back to page page 6, which lays out the different strategies that we offer at Times Square. And on the domestic side, you are in our small/mid-cap asset strategy with $2.5 billion of total assets. We recently reopened our small-cap strategy. This strategy we had closed to new clients about 15 years ago at roughly the same asset level, around $3.5 billion. And generally speaking, over the last dozen or so years, what led us to reconsider reopening it, and we look at this every year, look at our capacity, look at our trade liquidity, is that the market is what you define as being a small cap stock has gotten bigger and bigger over that time. It's probably roughly doubled the average market cap weight of the index from 15 years ago to today. I kind of remember way back when I started in this business, you used to buy a small cap stock below $1 billion and you sold it at $2 billion market cap. And now that's probably a starting point for some of the small cap names in the universe. We've also seen trade liquidity volumes increase in the small cap space. So we can buy and sell more stocks today than we could have done it 15 years ago without pushing prices too much, without having a lot of market impact. And yes, we've seen some flows out. I think broadly speaking across the board, some for performance reasons, certainly. I think more have been given by allocation. People have had movements from U.S. equities to other asset classes, and we've seen that in our small cap strategy, and for a mid cap strategy. And that's also created some capacity. So SMID growth peak assets were probably back in 2013, and that number was probably around, we're at 2.5 right now. Rather than guess, I'll give you the exact number. It was about $5.5 billion. And small cap peak assets around the same time, about $5 billion. Now, part of that's also market appreciation, market depreciation as well.
Maybe I missed this, and I apologize if you shared this and I missed it. But I mean, the returns compared to the benchmarks, you've been underperforming. And my question is, how have you compared on the risks side of the equation compared to the benchmarks?
We tend to have a lower risk profile than the benchmark. We tend, and depending on which measure you wish to use, our beta, which is a measure of market sensitivity, tends to run around 0.85 or 85% of the variability of the benchmark. We tend to also do better in down markets. You were asking earlier about down capture versus up capture. We tend to have a lower down capture than the market when over the last 10 years when the benchmark has underperformed. So just think about a negative quarter for the benchmark. Most of the time we've outperformed, and generally speaking the measure of outperformance is annualized to around 3% during down markets, whereas we've underperformed raging up markets by a bit more, by about more like 1.5 to 2% on the upside. The shorthand way I often think about it is in up versus down markets, we tend to have lower highs when the market's going up, but much higher lows when the market's going down.
Anybody have any additional questions? Okay.
Thank you very much. And
Thank you very much.
Appreciate the relationship that you've had with us, and appreciate your forbearance given the recent performance.
Absolutely. Thank you. Okay, item number 4 on our agenda is to approve the minutes of the meeting of January 10th, 2019. I have a motion and a second on item 4. All in favor? Aye. All opposed? Motion carries. Item number 5 is ratify approvals. We have 4 items, I believe. I'll entertain a motion subject to individual considerations. I have a motion and a second on item 5. All in favor? Aye. All opposed? Motion carries. Item number 6 is to approve the claims docket. I have a motion and a second on item 6. All in favor? Aye. All opposed? Motion carries. Item number 7 is to approve the following applications for service retirement. We have 10 applications. A motion and a second on item 7. All in favor? Aye. All opposed? Motion carries. Item number 8 is to receive the report of death, authorize payment of the $5,000 death benefit, and approve continuation of the pension to the spouse. A motion and a second on item 8. All in favor? Aye. All opposed? Motion carries. Item number 9 is receive the report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. A motion and a second on item 9. All in favor? All opposed? Motion carries. Item number 10 is to receive the report of death, authorize secretary to make necessary changes to conform on the following. I have a motion and a second on item 10. All in favor? Aye. All opposed? Motion carries. Item 11 is to approve the following application of vested rights. We have 6 applications. I have a motion and a second on item 11. All in favor? Aye. All opposed? Motion carries. Item number 12 is items for individual consideration. We have one item. It's the contract between the OCERS and Independent Medical Examinations, LLC. Is there anything we need to know?
No, there were no changes to the contract. The fees are exactly the same, and this is the medical provider that we use to do the disability evaluations.
Thank you. Entertain a motion on item 12. Have a motion and a second on item 12. All in favor? All opposed? Motion carries. Item 13 is the investment consultant report.
Good morning, everyone. So you have a handful of books from us, the Brown Quarterly book, the January ASAP. So you'll note I didn't come in January because I didn't want to talk about the December numbers. I waited for January to happen so I could come back for a really good month. And then finally, the 2018 year in review, which I won't go through. That's just for your own benefit if you'd like to read about how bad everything was in 2018. So you heard from the 2 small cap managers this morning, and I think it's pretty reflective of what went on in calendar year 2018. We really came through the first 3 quarters of the year where U.S. equity markets were doing fairly well. We had a bit of a downturn early in the year and then bounced back through the end of the third quarter where U.S. stocks were double-digit returns for the S&P and for the Russell 2000. And then the fourth quarter, growing concerns about Fed policy and how aggressive they would be in raising rates, coupled with concerns about slowing growth in China and trade policy, really put a hamper on the equity markets, and U.S. stocks sold off dramatically in the fourth quarter. Pat Malcolm with Ernest touched on this volatility. I think last year, when I was here in January or February, one of the things we were talking about, and one of the charts we had in our material was talking about how little volatility was in the market in 2017. There were less than 10 days in the year where the S&P moved by more than 1%, which is unprecedented low volatility. This 2018, we had many days where you saw the market moving, particularly in the fourth quarter in December, 2% or more, sometimes 3%, which is high, but not unusual over long periods of time. And so, as you heard from the manager, certainly seeing some opportunities to take advantage of that volatility. If you turn in the brown book to page 8, this just shows what you saw in some of the other material for major markets, major market indices for calendar year 2018. So on the left side of the page, those blue bars, those are equity markets, starting with the S&P, or large cap U.S. stocks, actually the best performing, down 4.4% for the year, followed by the HFRI fund-to-fund strategic, while not an asset class, those are equity-oriented hedge funds. That's down about 6%. Small cap down 11%. EFI, which is international and developed, down 13.5% roughly, and emerging markets down 14.25% for the year. So overall, U.S., while down, outperformed non-U.S. Actually, in the fourth quarter, which is where we really saw U.S. stocks fall off, and international and emerging markets actually did a little bit better because they suffered a little more pain early on. Bonds were essentially flat as we saw yields going up for much of the first 3 quarters of the year, putting downward pressure on bond prices. In your portfolio, within the fixed income strategies, we have a number of things in place to offset rising interest rates or to reduce interest rate sensitivity. That was beneficial the first 3 quarters of the year. In the fourth quarter, when equity markets sold off, we also saw a flight to quality back into treasuries. And so the 10-year treasury, which went from about 2.6 to 3.2 from the beginning of the year to the end of the third quarter, fell from 3.2 to where it is today at about 2.6%. So actually having treasury exposure and interest rate sensitivity was beneficial in the fourth quarter. Your portfolio on the fixed income side has much less. It's positioned longer term to protect against rising rates and to add a little bit more yield than the benchmark. The next page I think is really important, page 9. This is 10-year returns for these same indices for that same endpoint, December 31, 2018. So what you'll see here for that 10-year period, even with the negative returns of 2018, large cap stocks are up 13% annualized over the last 10 years. Small cap stocks up about 12%. International and emerging markets somewhere between 7 and 8.5%. And bonds about 3.5%, your Bloomberg U.S. aggregate, which is investment grade bonds. So we've come through a 10-year period of very strong returns. We're not quite there. We will be next month of taking off that 2008 year from your 10-year number, but you'll see that in your numbers. And one of the things that I'll point out to you in a moment is just where you are today in terms of the 10-year return versus where you were last year. But if you turn to page 28, I think this is important. Ernest showed this in terms of their portfolio growth. I wish we had a 10-year period on here because it would be enlightening to see that. But the last 3 years, the portfolio has grown from $642.7 million to $683 million. $76.5 million in net outflows. That's contributions in, city and employee contributions, less benefit payments and other expenses out. So that came out. The portfolio from an investment standpoint grew by almost $117 million over that 3-year period. For the 1 year, obviously it was a challenging year, down $33.7 million for the year. At the end of January, the portfolio bounced back from $683 million at the end of December to $716 million at the end of January. So a big move of about $33 million, well, that same $33 million to the positive from an investment standpoint. And I don't know what cash flows are, but limited. Page 29, and I want to focus on these 10-year numbers because I think it's important. So now you've done a very good job in managing expectations and being realistic in return expectations. You've taken advantage of fairly decent markets to say, well, it's not always going to be this way, and lowered that return assumption, your actual return assumption, down to 7.1. The last 10 years, ending 12/31/2018, the 10-year return on the portfolio is 8.42%. So you've outperformed that. On a forward-looking basis, based on our capital market assumptions, that 8.4 is probably going to be difficult to achieve over the next 10 years, just based on where we are in terms of valuations and yields. So this is where I want to throw a question out there for a guess. So last year, 2017, the portfolio was up about 16%. This year, portfolio is down 4%. Currently, the 10-year return is 8.4%. Would anybody have a guess of what your 10-year return was December 31 of 2017? Coming off a 17% return. 6.2%. So I just point that out. Are you happier with a 17% 1-year return and a 6.2% 10-year return, or a 10-year return that's above your required return by 1.5%? Now you'd say, well, I always want my return to be above that. But my point is, these are long-term liabilities. We need to think about long-term and what long-term results are. We emphasize every month that this portfolio is built to participate in up markets and provide protection in down markets, which I think was the question you were getting at when you were asking Times Square about their up and down capture. If you go to page 32 and 33, I'll go to page 33 because we'll see these 10-year numbers. So on page 33 in the upper right, some 10-year relative statistics. So the return of 8.42% annualized over that 10-year period is a little bit 9 basis points behind the policy index. The policy index does not include hedge strategies. It's long-only strategies. So in a period where equity markets are way up, and by being long-only and not having insurance in your portfolio, you could have gained a little bit more. Your volatility or risk, as measured by standard deviation, is 7.65 versus that policy index of 8.5. So about 90 basis points less. So lower risk, about the same return. From a risk-adjusted standpoint, the Sharpe ratio is a measure of risk-adjusted returns and efficiency. You have a more efficient portfolio by the way you've implemented than what the policy index or the asset allocation would suggest. And that's what we're really trying to do. We know there's going to be times where markets go up and down, you may not capture all of the upside. Hopefully when markets are down over sustained periods of time, you're providing protection, and you've done that. And in the middle of the page, this is up capture, down capture statistics for that 10-year period. What this is showing, the up capture of 92.3% when the asset allocation mix based on the indexes is up. So just think of it as your policy is up 10%, you're up 9.2%. So you're capturing 92% of the upside. When the market or broad policy index is down, you're capturing 88% of that. Those are pretty good up and down capture numbers. Now you can't necessarily build a portfolio that's going to be over 100% up capture without having more down capture or more sensitivity. That beta statistic is just represents the sensitivity of your portfolio to the direction of markets. And so we want to get that lower than 1. 1 would mean you're moving perfectly in sync with the direction of the markets. We want some alpha built in or some from active management, whether it be at the manager level or the asset allocation level. We want that number lower than 1 and at 0.87 or a lower vol than the market. Rolling forward 1 month, looking at the ASAP report, in terms of your asset allocation at the end of January, we're really neutral, probably closer to neutral to targets than you've been in a while, at least from a broad asset class, equity, fixed income, and real assets. The primary mechanism of rebalancing in your portfolio is through cash flow needs to pay operating expenses. So what we look at on a monthly basis is to say, okay, well, these are our targets for each asset class, where we want to be from a risk standpoint. If we need to raise money to pay benefits, we're going to take it from what is overweight in the actual allocation relative to targets. Currently, small cap within equities continues to be the most overweight. That would be our source for any cash flow needs currently. But you're really, fixed income is at targets, and we think that's appropriate where we are today. We think while coming into last year, equity markets were pretty rich and overvalued. The decline we saw in 2018, particularly in the fourth quarter, really brought non-U.S. and emerging markets into an attractive valuation territory, as well as small cap. Large cap really came down just slightly below the 10-year historical average, and through January now is back up from a valuation standpoint above the trailing 10-year PE. But we would want to be as neutral as possible in terms of allocation. Looking at page 2, this is just rolling forward a month, and you can see how strong returns were for the month by asset class. This is each asset class in your portfolio. So large cap was up about 8.5% in the month of January, where the benchmark was up 8. Still, on a one-year basis, your large cap allocation trails the benchmark now by about 60 basis points. Much of that was in tech. In the year, your large cap is predominantly passive, or what we in tech is very benchmark risk controlled, that strategy. They're not a bottom-up stock picker. Their process, not to get too technical, it's volatility capture, but they're trying to stay pretty close to the weightings in the benchmark with their position weightings. However, the strategy will overweight the stocks in the benchmark that tend to have more volatility. So many people think when volatility spikes in the market that should be a positive for that strategy's performance. But it's not market volatility, it's individual stock price volatility. So when everything moves in one direction, that's not necessarily beneficial. And in this case, it tends to overweight smaller cap names in the large cap universe that have more price volatility. So in a year when small cap underperformed large cap fairly dramatically, that had an impact to the index strategy. So that's really where that dispersion's coming from. Within small cap, you see the relative returns for 1 year down 483 relative to 261. A lot of that is Times Square. We'll come back to those two managers in a minute. But over the last 3 and 5 years and over the 10 years, very good returns from small cap on a relative and absolute basis. Long short equity, so this is now the K2 Mauna Kea platform, which is fully funded. It did provide some protection in the fourth quarter relative to the broad market. And in the month of January was up 5%. One of the things that we talked about in terms of transitioning from the off-the-shelf fund of funds, the K2 Overseas Fund that you were in, to the Mauna Kea platform where you could be a little bit more customized. Not only is the fee savings dramatic, but the ability to customize and create a little bit different risk-return profile. One of the issues that we felt we had with fund of funds was that they were so conservative that while, yes, you were getting a lot of protection in down markets, you weren't getting near enough of the upside. This is a very minimal window, but we actually are getting a little bit more of what we would have expected here. So the upside, you don't necessarily see it here, but the 5.12 for the month relative to the HRI Strategic, which is a index of other equity long short fund of funds, that was up 4.3%. So you outperformed that basket that generally is going to be more conservative, getting a little bit more of the upside in a strong month. We saw the same thing in the fourth quarter, protected against the long-only market, down about 9, and the ACWI global benchmark was down 12, whereas the HFRI fund-to-fund strategic was down about 6. So more more diversification provided more protection in those types of strategies. This not as much protection, but a little bit more of the upside, but still getting protection, if you will. International and emerging markets kind of in line. International overall has outperformed a little bit on a 1-year basis, still a big bounce back. There was an announcement a few weeks ago from Wells Capital, Wasatch, the emerging market small cap manager. They've done some repositioning within their, they have a number of emerging market strategies. They had an India-only strategy that was the lead portfolio manager on that strategy. Anjay, I get his name wrong. He was promoted to become the co-PM on the emerging market small cap strategy that you're in. So Roger Edgley, who is the lead portfolio manager, is still there working on this strategy, but they did announce that they're moving Anjay Anjay Krishnan to a co-PM on this strategy. We've had several discussions with them on this. Not that it's a change, but just trying to get an understanding what you're doing. Is this or telegraphing some positioning that Roger Edgley might be moving out? That's at some point, yes, as Roger's getting older, but it's not on the immediate horizon. So it's just something that they sent out an announcement last week, and just wanted to follow up with that. So just coming back to the two small cap managers that presented today, you'll see on the ASAP on page 3, Times Square you've had since 2010, and Ernest goes all the way back to May of 2003. As I mentioned to start with, they're intended to complement one another. Times Square is a growth-oriented manager, tend to be what we'd call a quality growth, where they should provide a little bit more protection in down markets. Their upside-downside capture numbers should be similar to what we're seeing on your total portfolio. Ernest Partners, they're filling the value component. We would describe them as a relative value. They're certainly not a deep value manager. They look at valuation components, but they're also, historically, their characteristics will tend to have a little bit more growth orientation than other value managers will. And at periods of time, it's been beneficial the last several years where growth has significantly outperformed value. In periods where deep value is outperforming, they tend to lag. But certainly as we look at that strategy, very high correlation to the value benchmark. Since inception, Ernest, going back close to 16 years, has generated an 11.5% annualized return versus that benchmark of about 10. So pretty good long-term performance. I can tell you there were periods in there, particularly from 04 to 07, when value was outperforming significantly. Even though they're a value manager, they were lagging value benchmarks, and it was challenging. Times Square, coming on 9 years at the end of next month. Since inception, they're up 13.28 compared to the benchmark up 14. So they've trailed the benchmark, and I think they owned it, and they've owned it a couple times since they've been here. The last few years it has been challenging for them. We've talked a lot about nothing philosophically has changed. They have made some changes to the team where they have felt the analyst in certain areas, particularly the healthcare analyst, wasn't performing well, and so they've actually replaced that person, a different healthcare analyst, twice now, and made some changes there. Much of the underperformance was in the last year, that 300 basis points. I'll tell you, we're watching this closely. As you know, we tend to be patient with performance issues if philosophical or firm issues haven't changed, and I think it's benefited our clients and you over time so that you're not churning managers in and out of the portfolio. But this is one we're watching closely. One of the things, and why I asked about assets and movement of assets, one of the things that we can get caught in is, while being patient because nothing has changed, if everyone else is saying we don't want to be patient and running for the doors, you don't want that firm to be like, okay, well now we can't pay our people and can't do things. The assets at Times Square are significant. Really, for us, they're probably more right-sized today in terms of a small to mid-cap manager than they were 2 years ago when they had $5 billion in SMID and $5 billion in small. That's really big for small and SMID. So in terms of being able to run their business and pay their people, they're significantly well capitalized and have more than enough assets. But it is, we're watching them closely, and that's something that we may talk further about. But at this point, not an imminent concern. And just, Randy, because I know you asked them about this, those statistics on their up and down capture numbers are in our quarter book on page 51. So going back to inception of February 2010, their return is about just under 12% versus the benchmark, and this is different than what's on the ASAP because it's a month, they're two different time frames, versus the benchmark at 1276. So up about 12%, so about 70, 80 basis points behind. The risk or standard deviation is more than 1% lower, and actually a higher Sharpe ratio than the benchmark over that period, 0.76 versus 0.75. The up and down capture statistics, you see those in the middle of the page versus the middle column is or the column on the left is versus the growth benchmark, 87% up capture and 88% down capture. So if anything, they haven't captured as much of the upside as perhaps would like, but they certainly, the downside capture is consistent with what we would expect and actually generating positive alpha and over that time period. So again, we're looking at a lot of different factors. We want to be patient, but this is one we are watching them closely. Finally, at the December meeting, you may recall that we came to the board that there was a change at one of the managers on the Mauna Kea platform, Kenton. Kenton was led by a senior portfolio manager, Mark Kenton. Name was on the door. 3 co-PMs that he let go abruptly, and we were able to negotiate an exception to their redemption provisions if we could get out right away in December, so that you all put in redemption for December 31, and at the December meeting approved the reallocation of those proceeds to other managers on the platform. That money came back Friday last week, $5,200,000, and we've provided the additional subscription forms to Renee and Wiley to reallocate that as was approved at the December meeting, and that will be done. Forms need to go in today, and the money will be reallocated for March 1 investment on the platform.
Anyone have any questions? Hearing none, thank you, sir.
Thank you.
Jason, on the 2 people that we heard from today, I understand it's just for 1 month, but it looks like for a growth and a value, they were awfully close in performance. Is that just the small caps in general rising, or?
Yeah, if you look at the index, the small cap SMID growth index up 11.9, and it says custom index because it used to be a small cap strategy, then you moved into a SMID strategy, but now that's the Russell 2500 value. The benchmarks are up similarly, so there was a big bounce in small cap for the month.
Anyone else? Okay. Item number 14 is comments from board, staff, and citizens. Again, I'd like to welcome Kenny.
Welcome, Kenton.
Hearing no other comments, we are adjourned at 11:13. Thank you.